Do you know what an inherited IRA is? More importantly, do you know the rules around them? There's a stretch rule, there's a 10-year rule. You're going to want to watch this whole episode to understand how this all works and how it applies to you. Enjoy the show. We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in. Welcome, everyone, to the Secure Your Retirement podcast. We're excited that you're tuning in. We've got a great episode all around this concept of inherited IRA and the RMDs that we have to take on them. And there's a lot of nuances to it, there's a lot of different rules. So, for that reason, we have brought in our very own Taylor Wolverton, who is a certified financial planner as well as an EA, which is very similar to a CPA, so very well versed on tax. So you take her financial planning brain and her tax strategy brain, put that together, and we can really talk through some cool things and come up with some great strategies. So, Taylor, thanks for hopping on with us today.
Yeah, you're welcome.
So, like I said, the concept of this episode today is really to inform people about inherited IRAs and what we have to do to make sure we're following the IRS's rules. And the big part of that is these required minimum distributions. So, while you are living and you reach a certain age in your own IRA, typically that's 73 or age 75, you have what's called a required minimum distribution. We've done episodes on that before. So if you want to learn more about your own required minimum distribution for your own IRA, check out that episode. So today is more focused on inherited IRA RMDs. When you inherit it, you either inherited it from a spouse or a non-spouse, and both of those have different rules. And then to throw another wrench into it, there were rule changes that happened in 2020. So if it was prior to 2020 that you inherited the IRA, there's one set of rules. If you inherited the IRA after 2020, there's another set of rules. So clearly it's going to be a very fun episode, and I'm glad Taylor's here to kind of walk us through. So Taylor, let's dive in on let's start with the what we would call the old rule, which is prior to 2020. If you inherited an IRA, and let's say for this one a non-spouse. So think if you're listening, think you maybe inherited an IRA from a sibling, or you inherited an IRA from a friend or a family member, but a non-spouse. You are a non-spouse beneficiary. What do we need to think about there, Taylor?
Yeah, so the rules, if you were the non-spouse beneficiary of an IRA prior to 2020, so this is 2019 or earlier, the Secure Act is what changed these rules. So before the rules changed, we referred to the way that inherited IRA distributions worked as like a stretch IRA. And that's because the factors that determine your distribution was the account balance the prior year, and then also your life expectancy as the beneficiary based on the IRS's table that they publish. It's called the Single Life Expectancy Table. And so you could use your own life expectancy as the beneficiary. It updates every single year as you go along and have that account, and it basically stretches out the distributions over your entire lifetime. So if you inherited an IRA from someone who was older than you, then it's based on your life expectancy, and now those distributions get stretched out over your life expectancy. So you have a longer amount of time than even the original account owner would have to take those distributions. But like we said, the Secure Act in 2019 changed those rules, eliminated the stretch IRA provision. So now we have to accelerate our distributions, which is kind of what we're going to get into in this episode now.
Yeah. So, and that's a nice overview of the old stretch IRA. So, when that went away in 2020, we had to adapt. And by the way, if you're listening, and you're taking RMDs on your own IRA, well, the custodians, and when I say custodians, you can think of Charles Schwab or Fidelity or Vanguard. They have a responsibility to calculate what your own RMD is. And they report that to the IRS. They also report it to you to make sure that you take what you're supposed to take out on your own IRA. With inherited IRAs, though, because there's so many nuances in the rules, they don't calculate that for you and they do not remind you that you need to take it. So I think it's very important as we're kind of understanding these rules and very likely getting a little bit confused on it, that it is important to work with someone that can help you stay on top of your inherited IRAs as well as strategize around them as far as the distribution goes and how it's going to affect your financial plan and your tax plan as well. So I just wanted to throw that in there as you listen through this. And if you have an inherited IRA and you need guidance, we're always here for that. So Taylor, let's talk about same category, non-spouse
Mhm.
beneficiaries that inherited their IRA in January of 2020 or later. What does that look like now?
Yes. So, and actually, too, with the Secure Act, the reason why we're having this conversation now is even though these laws were announced in 2020, there's been so much kind of murkiness around the rules that the IRS has actually waived these requirements every single year until 2025 now. So this is the first year that these rules actually apply and are actually being enforced by the IRS because now they've clarified exactly what we need to do to follow those rules and avoid penalties. So if you're a non-spouse beneficiary, so again, if you're like the sibling of the original account owner or the son, daughter, child, friend, neighbor, whatever it happens to be, there are kind of two rules that we look at. The first one is the required minimum distribution, the RMD. There's potentially an RMD for your inherited IRA. The second rule that will apply, I should say, is also the 10-year rule. So, like I said, the Stretch IRA provision was 2019 and prior, spreading it out over your entire lifetime. But now the IRS has asked us to accelerate those distributions by enforcing the 10-year rule. So, first, kind of one that we're looking at, the RMD, applies if the original account owner was taking RMDs themselves. So if the person that you inherited the account from was 73 or older, they were taking required minimum distributions themselves, they passed away, you inherited the account. Because the original owner was taking RMDs, you now, as the beneficiary, have to also continue those RMDs. Regardless of your age as the beneficiary, you have to continue the RMDs. And also the 10-year rule applies as well, meaning you have to distribute the entire account balance by the 10th year after the original owner passes away. So we're going to talk about a couple of examples to show when certain rules apply and what that looks like and kind of on a timeline. So,
So let me say that back to you to make sure that we're on the same page here, Taylor. So let's just assume that you inherited an IRA from a grandparent, and the grandparent, well, let's just say they were 80, so they were already in required minimum distribution phase for themselves. They pass away, you inherit this account, and because they were taking required minimums, you have to continue taking required minimums for them. There
yes.
is a minimum amount that you have to take every year, but also there's this caveat that you have to take all of the account out by the end of the 10 years of after you inherited it. So in
Hmm.
reality, when I think about that, the minimum is not a tenth of the account every single year. The minimum's much less than that. So we need to be very
Yes,
strategic on how we're going to clear out this account. And definitely, we don't want that to sneak up on us.
exactly. Yes.
Okay, so let's go through some of the examples that you've got, and I'm sure I'll have questions there too.
Yeah. Okay, so the rule that changes is the required minimum distribution, depending on the age that the original owner passed away. The 10-year rule always applies. So, first example, let's say there's a beneficiary who inherited an IRA, they're 60 years old, and they inherit it from their sibling who was 65 at the time that they passed away. So the sibling who passed away, the original account owner was 65. That means they were not taking their own required minimum distributions if they're younger than age 73, which in this example they are. So there is no required minimum distribution for the inherited IRA owner. Now, as you as the beneficiary do not have to take distributions, but the 10-year rule does always apply regardless of the age of the original owner. So that means, let's say the sibling who was the original account owner passed away last year in 2024. So now, as the beneficiary of the account, the beneficiary has 10 years to empty that account altogether. So by December 31st, 2034, 10 years after the original owner passed away, that account balance has to be zero. So if they wanted to, they could wait until December 31st, 2024, distribute the entire account balance at that point in time. There's no penalties for not spreading it out over those 10 years. But the more tax efficient way to do that is to spread it out over those 10 years rather than waiting until the final year where an entire distribution could push you into a higher tax bracket. So even if there's not a requirement to take a distribution, it is so important to consider whether you want to take a distribution, even if the IRS is not forcing you to, there is still strategy involved in emptying that account eventually.
Right. And so it requires kind of staying on top of it and again not letting it sneak up
Yeah.
on you. The only way I could think it would make sense to wait until the 10th year is if you are in your example there you're 65 in this and maybe you're still working and maybe you make a high salary. So maybe you're what if you
Yeah.
make 300 plus thousand a year and it's $100,000 IRA that you inherited? Well, then it could make sense to wait until you did retire, your income
Mhm.
drops, and then you take significant distributions in those last couple of years of the 10-year rule.
Yes.
I think that's
Yes.
a rarity, but
Yeah.
it is one that could work. But I agree with you. In most cases, it makes sense to kind of spread it out and take advantage of lower income years. Okay, cool.
Yeah.
So what's another example on the flip side if they are taking RMDs?
Yeah, so this is kind of similar to what we had talked about earlier. The second example, the original account owner, I'm going to say they were in their 80s. Let's say they were like 87 years old when they passed away, and the beneficiary of this account again in 2024 is 60 years old. So now, because the original account owner was 87, they were taking RMDs. The beneficiary now, as the owner of the continue those RMDs, but we're going to get a little more specific around what that RMD is and how that gets calculated. So, one important piece of information to know is the prior year account balance. And first, let me say too, in the year that the original owner passes away, there's not an RMD for the inherited, for the beneficiary, the owner of the inherited IRA. In the year that the original owner passes away, the RMD is based on their lifetime. So it's only the next year after the original owner passes away that the inherited IRA RMD is in force. So in this example, let's say the original owner passes away in 2024. So now we're in 2025. So the first thing we need to know is the account balance the year prior. So on December 31st of 2024, I'm just going to say in this example, the account balance was $50,000. The other important factor to look at is now your life expectancy figure from the IRS table. They call it the single life expectancy table. You base it on your age as the beneficiary. So in 2025, let's say the beneficiary was age 61. So if you go and look at the IRS single life expectancy table for age 61, you'll see the life expectancy factor is 26.2. So to figure out the required minimum distribution for 2025, we're going to take the $50,000 account balance, divide it by the life expectancy factor 26.2, and we'll get the required minimum distribution for 2025 of around $1,908. So that's the minimum amount that has to come out of that account in 2025. But again, the 10-year rule also still applies. That account balance has to be zero by December 31st of 2034. So again, it might make sense to strategize, come up with a plan, look at your income for the next 10 years, and figure out if it's worth taking more than the required minimum distribution, or maybe you're in a situation where it doesn't make sense. But either way, you want to know what those rules are, what your RMD is, what your plan is, what the strategy is going to be moving forward. And
Yeah.
next year, I'll say too, for going forward, you still have the required minimum distribution every single year, but now you take the life expectancy factor and you subtract one for every single year going forward. So if the year starting, the life expectancy factor in our example is 26.2, For next year, you're going to subtract 1 and divide the account balance by 25.2. And then the year after, 24.2. So you go
Got it.
back to the original age on the life expectancy table for every single year of the calculation going forward.
Gotcha. So it's a moving number, is what I'm hearing
Yes,
year over year on the minimum
absolutely.
calculation. Now, it just simple and easy math here. Let's just say that every year our required minimum is $2,000 a year, and we've
Mhm.
got a $50,000 account. But if we're only taking the 2,000 a year for the 10 years, that's 2,000 times 10, that's 20,000 that's been taken out.
Mhm.
We have to clean it out by year 10. And so there's 30,000 left plus market growth. So let's just say there's, back to somewhere in the realm of 50,000 because it continued to grow. Now we've got a big distribution that we got to take by on that
Yeah,
year 10. So that's why,
exactly.
just sticking to the minimum may work for a little bit, but it could come back to bite you if we don't stay on top of it.
Yes,
Okay,
that's
so
right.
what are some exceptions to this 10-year rule? And how's all that work if we can still stretch it?
Yeah, there are some exceptions to where they can actually default back to the prior to Secure Act rules with the Stretch IRA, and that's for the surviving spouse, or if you're, as the beneficiary, disabled or chronically ill, or minor children of the original account owner, or if you're the beneficiary less than 10 years younger than the original account owner. So, I mean, in my experience, those exceptions are also pretty rare, but they do exist, so it is important to note.
Hmm. Yeah, I think I've seen one or two that fit the bill for the exception, but in most
Yeah.
cases, you're going to the 10-year rule. I mean, obviously, the
Yep.
surviving spouse is probably the most common
Yes. Right.
exception, and that's if my wife was to pass away, I would inherit her IRA. That's an exception to the 10-year rule. So let's talk about that, Taylor. Let's talk about
Yes.
spousal beneficiaries that inherited in 2020 and onwards. How does that work?
Yes. Yeah. So spouses have a little bit of different rules that they're allowed to follow according to the IRS. So one option that is available to surviving spouses is to take that inherited IRA account balance and roll it over into their own traditional IRA balance. What that does is allow you as the surviving spouse to delay any RMDs until your own RMD age. So if I'm a spouse, let's just say I'm 60 years old, my spouse passes away, my spouse has a traditional IRA. I choose to take that option, roll my deceased spouse's IRA into my own account, and now I can delay my RMDs until I'm 73 or 75, depending on your own RMD requirement for your age. So that allows you to delay your RMDs rather than taking it when your spouse would have, according to their own age. So that option makes sense, especially when you are the younger of yourself and your spouse, to give you more time before you're forced to take those distributions.
Yeah. And just in experience, I would say 90% of the time,
Yeah,
we're using that option, which is just to combine the decedent's IRA with the spouse's IRA, just dump them together, and then
yeah,
now you're under your own IRA rules, which is the RMD later on in life. So that one makes it simple,
exactly.
it makes it easy, but there are some times where we want to do something different, which is as a spouse, take it as an inherited IRA and not combine it with my own IRA. Why would we ever choose that option?
Yeah, that's the other option. You can maintain the account as an inherited IRA. For one, if you are the older spouse, that can be a better move because then the RMDs will be based on the decedent, the original owner, spouse, their age. So then it can give you, as the surviving spouse, a little more time to delay rather than having to start at your own RMD age, which would come sooner than your younger spouse. So if you're older, the older of the spouses, it can make sense to go the inherited IRA route. And also, if you are under the age of 59 and a half, it can make sense to make the account into an inherited IRA because you can take distributions Even if you're under 59 and a half, you can take distributions from an inherited IRA without penalty, as opposed to if you roll that account into your own traditional IRA, you're under age 59 and a half, you cannot take distributions from your own traditional IRA when you're under age 59 and a half without penalty. So if you want more flexibility in having access to that money and you're under 59 and a half, go the inherited IRA route.
Yeah. So age is going to be very important on a spousal
Yes.
beneficiary election. So this is all good. And everything we've talked about so far has been IRA, traditional IRA,
Yeah.
pre-tax IRA, which means we haven't paid a dime of taxes on it yet. So it goes without saying that when we're taking these withdrawals, it does become taxable income. And you are going to receive a
Right.
1099 for whatever RMD or RMD plus additional that you decide to take is going to be taxable that year. So that's something we really need to think about as well in your tax strategy and tax plan. But Taylor, let's take a minute and talk about Roth IRAs. A lot of people like the idea of a Roth, right? Roth
Hmm.
conversions are a hot topic,
Yeah.
funding Roth 401ks and IRAs because of this idea of future tax-free money and paying the tax on that money now. So it's a great concept, but how do inherited Roths now play into this whole conversation?
Yeah, I wanted to touch on Roth IRAs specifically because those rules are completely different. So if you inherit a Roth IRA, there is never a required minimum distribution. Regardless of the age of the original account owner, you will not have an RMD as the beneficiary. However, the 10-year rule does still apply. So again, 10 years, December 31st, 10 years after the original owner passed away, that Roth IRA account balance must be $0. But the logic for planning those distributions out over those 10 years is different with the Roth IRA because unlike the traditional IRA, as if you leave your Roth IRA invested, it continues growing through the future, then that growth is also tax free. So with the Roth IRA, it can actually make sense to do the opposite and leave that account balance for all 10 years where possible, because then you'll have a higher tax free account balance in that 10th year and you can distribute it all without any tax or penalty consequences in that 10th year. So a little bit different thought process with Roth IRAs because they are tax free and have different benefits than the traditional IRA.
Yeah, I mean, think about that from a a legacy planning perspective, right? A lot
Hmm.
of times when we have these conversations on Roth conversions, a lot of times we're doing conversions not necessarily for us, but we're doing it for our legacy and our inheritance so that they inherit money without as much of a tax burden. So, if we just put some simple numbers and easy numbers to it, let's say you leave behind $100,000 Roth IRA. Someone inherits it, and like Taylor said, there is no required minimum distribution. It still needs to be cleared out by year 10, but there's no minimum that we have to take along the way. With the traditional IRA, we very likely don't want to wait till year 10, but excuse me, sorry, with the Roth IRA, we want to try to wait till year 10 as much as possible because take that 100,000 and it grows at a decent rate of return in that 7% type of range over 10 years, that number is going to double. So 100,000 now becomes 200,000. If we're able to wait 10 years, now we've got a bigger asset which we can withdraw fully, completely tax free. So I think that's a pretty cool strategy to think about, which means we got to educate our beneficiaries a little bit or make sure that
Yeah.
they're working with a professional as well. So Taylor, this
Yeah.
has been very insightful and very helpful. Inherited IRAs are a little bit confusing, which again, I
Yeah.
stress the reason to be working with someone that understands them, that can help you kind of holistically look at the best way to inherit and then make those distributions along the way. So, Taylor, thanks a lot for your time
Definitely.
today. I'm sure everyone's going to love this episode.
Yeah, you're welcome. That was fun.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos.
Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.